The Nvidia Corp rating remains neutral. Stock price may be out of reach after its price increase nearly doubled in a year. On the other hand, AMD's portfolio of smaller, more agile products, with a track record of competing with Intel, gives AMD more room to grow. As a result of this stock split, the company is much more likely to attract new investors. But the biggest obstacle to a positive stock price outlook is value. The most significant disruptive trend in the chip industry, according to analysts at CFRA Research, is artificial intelligence. It's fascinating for AMD's bulls that they can get a share of Intel's server market. Investment analysts are less enthusiastic about AMD's $38 billion deal to acquire Xilinx later in the year. They say the transaction will instantly boost AMD's operating margins, cash flow, and earnings per share. The IT industry's median PS ratio is much lower than AMD's, giving the company an overall very high rating of A+. With 31 analysts raising their EPS forecasts, AMD's margins look strong. The company's quality rating is B+, and even with the company's challenges, Qualcomm competes in the mobile device industry. Almost every stat gives Intel at a C+ or an A. Like iPhones, Qualcomm Snapdragon processors are often found in high-end Android smartphones. For example, the Snapdragon X65 5G modem RF of the year achieved a 10 gigabit increase this year. With the next generation on the way, you can be sure Qualcomm will be at the forefront of development again. 5G cell phones are expected to cost around $3.8 billion over the period 2020 to 2024. Analysts at Goldman Sachs take a neutral view of Qualcomm's stock but believe the iPhone launch earlier this year gave Qualcomm a boost. In short, the bearish case against Qualcomm shares is based on concerns for the future, not current trends. It is a significant challenge for Qualcomm in China because MediaTek, a Taiwanese company, also operates in the market. Some sources say Apple is interested in building components in-house. According to Google 9 to 5, Google, Samsung are on the same path. As a result, each of the semiconductor titans covered here has created its unique category. In terms of natural growth, Nvidia Corporation is one of the fastest growing mega caps. And when it comes to the company's business growth potential, there is plenty of stock split of 4:1. Based on the stock split, the target price for Nvidia is the US $250. Next month, the semiconductor company is expected to report robust revenue growth. The company's financial records are also likely to be published in the second quarter, on August 18, 2021. Next month's earnings are projected to be excellent. If the company is successful, it could begin a new phase of growth known as in mid-single-digit growth. Nvidia is projected to announce second quarter revenue of $22 CMP's revenue is estimated at $400 million in the second quarter of this year, which could grow to $2 billion by the end of next year. The rising gross margins, which are an essential metric for the semiconductor business, are partly attributable to Nvidia's purchase of Mellanox. It looks like the earnings report that Nvidia has scheduled for later this year will be enough of a catalyst to send stocks to new highs. I'm all set for dips below Nvidia's support level, as inventory isn't cheap. Slowing sales growth, declining gross margins are two of the biggest threats to Nvidia's stock. Nevertheless, Nvidia shares generally reward outstanding performance. The company's 5-year track record of exceptional financial results motivates investors to buy shares at a high profit-to-price multiple. Nvidia is the global leader in high-performance graphics processing. The company specializes in large-scale visual computing and manufactures GPU chips that power everything from smartphones to supercomputers. Nvidia has been around for over 20 years and is now valued at $156.5 billion with a P ratio of 48. It also pays a dividend of $0.48 per share each year, and its ratio of PEG is 1.83. GPUs Nvidia are found in most personal computers, laptops, workstations, servers, and game consoles due to its advanced performance qualities such as energy efficiency and low. Nvidia was founded in 1993 by a man named Jan Hassoun Huang. He intended to advance graphics technology to improve the state of games. Nvidia has experienced tremendous growth since the early 1990s. It all started in 1993 and had just $3.2 million in revenue. Today, it has revenues of $7.4 billion. In addition, the company grew from an initial public offering price of $22 per share to an all-time high of $217. The company's annual revenues grew from $130 million to more than $4 billion in that period. The company is also aware of financial risk, having experienced a 22% loss in one day in August. However, it has also experienced 20% annual growth in EPS over the past 5 years. In addition, it has increased its dividend annually for 9 consecutive years. Then there's Nvidia Corporation, another semiconductor company based in Santa Clara, California. The company has had tremendous success through its workstation notebook and mobile GPUs. Inventory has increased by over 1,400% over the past 5 years. The company is highly profitable and is seeing strong demand for its GPU chips. Through share buybacks and annual dividend payments, Nvidia has increased its dividends for 25 consecutive years. Its yearly premium is currently $0.13, representing a yield of 0.40%. The current dividend yield represents a significant amount of short-term income. With such a low P ratio, the stock offers enormous potential for dividend growth. Nvidia may not be the best buy in the semiconductor market. Still, it has provided investors with incredible returns over the long term. Over the past 5 years, the stock has returned just 56%, outperforming the S&P 500 and the Nasdaq Composite Index.